In your journey with trading, you probably heard something like,
"Just enter on this 15-minute order block, and you'll make $500 every day."
And the result goes like this. And then someone else says,
"You're doing it wrong. You need to use this indicator along with it."
And the result goes like this. I need you to say enough to that nonsense. As someone who's been through a lot of these so-called strategies, I can tell you wholeheartedly that, first, relying solely on the 15-minute chart won't make you profitable. Second, you can have years of consistently profitable results without using technical indicators. In this lesson, I'll share with you 3 golden tips that will help you avoid losing on order blocks and in trading altogether. See you after the disclaimer. Tip number 1. Market trend. There are many factors that can cause a market to trend, and one of them is the involvement of central banks and hedge funds. These investors are highly intelligent with their capital, so it's a good idea to follow their lead and ride the waves they create. So, focus on buying when the market is trending higher and exit when it reaches an opposing premium array. Have on your notes that you want to stop following the trend when the price forms a high followed by a low, then a higher high, and finally a low that breaks the previous low on the daily chart, forming the pattern which is known as the bearish breaker, and vice versa for bearish trend conditions. Tip number 2. Avoid trading retracement legs. In any trending market, as defined by anyone's understanding of a trending market, the price doesn't move in a straight line. It always does these pullbacks, retracements, or corrections along the way. While these retracements are proven to be tradable, they require a high level of understanding of how markets move. Moreover, they are not as rewarding as trading along with the trend. So in an environment that's difficult to analyze, and not highly rewarding when it's finally done correctly, it would be advisable to avoid looking for order block entries or any other trading entries that go against the trend. Tip number 3. The higher timeframes. Has it ever happened to you that you entered at an order block level along with the trend direction, but the price kept moving lower until it hit the swing low, paused for a bit, and then reversed to move higher? As we mentioned earlier, central banks are the real movers of these markets. While you might see their footprints intraday, they don't always place their orders there. They tend to focus more on the higher time frames. And while you're waiting for a reaction off a 1-hour order block, the algorithm is intentionally pushing the price lower to trap retail traders. This allows it to offer the price for the big players at a higher time frame discount array, such as a daily fair value gap or a daily order block. To avoid losing in this condition, always have your higher time frame levels present on your chart and consider not entering a trade outside a kill zone. Hit the subscribe button for a part 2 if you enjoyed and gained new information from this lesson. Also feel free to share your thoughts in the comments below. Till next time, be safe.